Welcome back in. It is time for Money Tuesday, and a new tax law signed by Governor Kay Ivey in April. It takes effect January the 1st. It affects certain taxpayers who have retirement accounts. Here to explain it for us, break it down in layman's terms, Marshall Clay with the Welch Group. Good morning.
Good morning. How are you?
Good to see you. I think anytime we start talking taxes, people get concerned because it is confusing. Who does this one affect?
Yeah, so everyone wants that silver bullet to save themselves a large amount of money on taxes, but I think a lot of times it's a lot of small things that you can do that can ultimately save you a lot of money. So this particular law, it's a state income tax exemption for retirees who are age 65 and older.
Okay, 65 and older is the key point here. Right. And go ahead and walk us through it.
And it's $6,000 per taxpayer. So that's the key. So if you're an individual filer, for example, and you're in the 5% tax bracket, from a state perspective, that can save you up to excuse me, up to $300. If you're joint filing and both you and your spouse have an IRA and you're taking distributions from those individual retirement accounts, you can get 2 exemptions, which would save you upwards of $600. So it's not chump change.
Okay, give us a hypothetical of an idea of who this would help.
Yeah, so I think when you're in retirement, one of the key things that I talk to clients about is being really conscious of how you're making distributions from these retirement accounts. So a lot of times what will happen is you have one spouse who says, well, look, I've got my IRA, I'm just going to take distributions from my IRA and we'll worry about yours later. So a hypothetical that would help you take advantage of this particular law is instead of taking all of your distributions from one IRA, you would take $6,000, for example, from one spouse's IRA and then $6,000 from the other, so you maximize that state income tax deduction. Now, there's certain reasons why you may want to take more from a particular IRA than others. For example, if one spouse has a required minimum distribution, you obviously have to satisfy that from the federal level, but you want to make sure that you're pulling the money that you need from the different accounts in a way that maximizes your tax efficiency.
So you obviously need to talk to someone and give you some guidance. I guess that'd be the best way. And for folks who are watching who may not be at retirement age yet, they're not used to being worried about that distribution. Why is that distribution necessary?
Well, this particular one, if you're below 72, it's not a required minimum distribution, but I found that most people when they enter retirement, say 65, 66, 67, they need money from their portfolio to maintain lifestyle, to generate cash.
And they may not have done it before this law was in effect.
Correct. And so if they don't have any other after-tax accounts, like an individual brokerage account or a joint brokerage account, they're reliant on those individual retirement accounts or old 401ks to meet their cash flow needs. So this is a way where you can kind of think through how you need your money or where you're going to pull your money from, and it can maximize that tax efficiency. And this is a new law, so if you're filing your own tax return, now this law won't take effect until January of 2023, so when you're filing your taxes in April, hopefully before April of 2024, make sure you get with your accountants, make sure that they know. I mean, oftentimes they do.
Talk with them about that.
Talk with them about it, but certainly if you're doing your own taxes, this is something that you want to be aware of, because $600 savings in this environment can go a long way.
All right, great advice. Thank you, sir. Marshall Clay with the Welch Group.